Welcome to part two of our three-part series titled Doing Good Gives You a Tax Break. My name is Taylor Bentu, and I'm the financial paraplanner for APC. If you haven't listened to part one, I would strongly encourage you to go back and have a listen. We previously talked about qualified charitable distributions, and today we're joined by Joe Ottaviano, certified financial planner and vice president of APC. Joe, the floor is all yours.
Thank you, Taylor, and welcome back, audience. We're going to talk about in this part two series a bunching strategy as part of your tax planning. And when we talk about bunching, we're talking about the opportunity that you would have to put a lot of your itemized deduction expenses in one tax year or calendar year, and then using your standard deduction in other years. And one statistic that really supports bunching as a strategy is the fact that only about 10% of taxpayers this year will actually be able to itemize deductions, which is far lower than it has been in the past. So we know one big change this year was the doubling of the standard deduction. As we talked about in part one, for a married couple filing jointly, that went from $12,000 to $24,000. And then secondly is the elimination of the majority of miscellaneous deductions, which on your Schedule A, you can find towards the bottom, and that would include tax preparation fees that you pay your tax preparer or CPA, the fees that you pay an investment advisor like us. Those are no longer deductible and can be included on Schedule A of Form 1040. So bunching, as I mentioned, is really a strategy to alternate between loading up on expenses in one calendar year and itemizing, and then in the following year, going back and using the standard deduction. And this isn't for everyone, but there may be opportunities in certain years where this makes sense for you. There are three main areas where you can use for bunching. One would be your charitable donations, because you do have discretion around those. And we're going to talk more about a donor advised fund strategy in part three of this series that supports this bunching strategy. Second would be property and state income taxes, which this year under the new tax law is capped at $10,000. And the third would be medical and dental expenses. So let's talk about charity. Let's say, for example, that you are accustomed to gifting $10,000 a year to your favorite charity or charities. Well, you could consider, for bunching purposes, bunching 2 or more years of donations into 1 year. And then for property income tax purposes, you could, both at the city and county level, especially for those of you that live in Knox County, could actually pay multiple years at one time because of when the city or county bills you for those taxes and when you ultimately need to pay those. So you might be able to consolidate 2 years into one calendar year. And then finally, your medical and dental expenses, you can claim on your tax form those that are in excess of 7.5% of your adjusted gross income. So let's look at an example. Income for this particular couple who are filing jointly is $125,000. They have deductions totaling $15,000, both property state income taxes of $5,000 and charitable contributions of $10,000. So they would, in this case, use the higher of the itemized deductions or the standard deduction. So they'll use the standard deduction of $24,000 less the income of $125,000, leaves taxable income of $101,000, and tax owed on that would be approximately $14,100. Under a bunching strategy, the income doesn't change, but now they double up on their property taxes and max out at $10,000. And in the charitable contribution category, they basically take 3 years worth into 1 year, and we'll talk about how to do that through a donor advised fund in section 3 or part 3 of this series. So in this case, their itemized deductions exceed their standard deduction. And if you take the 40,000 of itemized deductions less the income of 125, that leaves you a taxable income of 85,000. And the tax owed on that would be $10,580 approximately, or a savings in this case of $3,520. That is incredible, isn't it? Now, if you think about the next year when they don't do any bunching, then their tax, they would go right back to using the standard deduction, and their itemized deductions would be essentially zero because they consolidated all those into this current taxable year. So with that, I will turn it over to Taylor.
Thank you, Joe, and thanks to everyone who's been listening. If you have any questions or comments, please feel free to reach out to us. We would love to answer. And join us for part 3 of the series. Next time, we're going to talk about donor advised funds. And until then, have a wonderful day.